Hi guys, in this video today, we are going to talk about one of the most important things, especially for beginners to know what moves currencies, what actually moves the market. So let's dive into the video. What move currencies? Currencies move because of demand and supply, and demand and supply change because of real events in the world. So now let's talk about some of the forces that actually causes the movement of currencies. Now, interest rates. So what exactly is interest rate? Now, let's talk about it. When a country pays higher returns, it's more like a short definition of what exactly moves the market. But when we go deeper into it, we will understand how interest rate actually moves the market. When a country raises interest rates, investors rush to put money there because the returns are higher. That increases demand for the currency and the currency becomes stronger. You all know what exactly is going on here. But let's just look at the example, some of the relatable example. Think of two savings accounts. Now let's talk about two savings accounts. One pays 2% on your deposit, on your savings, and the other pays 12% on your savings. Which one will you go for? Bank A pays 2% and Bank B pays 12%. It is very obvious that people will rush to the Bank B that pays 12% on their savings. So everyone will rush to the 12% account. The more people want it, the more valuable it becomes. This is what happens when the US or Europe increases interest rates. Their currencies spikes. Now let's talk about another one, inflation. Higher inflation weakens a currency. Low inflation strengthens a currency. Now let's talk about example. You saw how the naira fell. Now let's use naira as the example. When prices in Nigeria started rising sharply, the same bread that was 500 naira became 1,200 naira. Foreign investors ran away. Yeah, there are some companies that actually closed down during this particular time because there was inflation in the country. So some companies actually closed down. So demand dropped and NGN Naira got weakened. We all witnessed this. Now, this is one of the things that moves markets. Now, let's talk about this. Now, let's talk about economic strengths. If a country's economy is strong, its currency gains value. If the economy is weak, its currencies fall. Now, example, if America release news that job numbers are strong, do you know what will happen to their currency? This is a good news. Simply means there's availability of jobs. So their currency is going to pump. Their currency is going to be very strong. But if the opposite happens, what will happen to their currency? You all know the answer to this question. So it is like hearing that a business is booming and people want to invest in that business. If the business is collapsing, you will see that people will pull out their money. Now, political stability. This is another thing that actually moves market. Countries with peaceful, stable government attract money. It attracts investors. People actually feel safe by investing in their countries. But countries with chaos lose value. Let me just mention one country like Iraq, Afghanistan, Pakistan. All these countries, their currencies are very, very low in value because of the problems, because of the wars that are happening. Another example is Ukraine. Now, whenever there is election tension in Nigeria, the naira usually weakens. Investors hate uncertainty. Forex reacts the same way globally. This doesn't happen to Nigeria only. Even in America, when there's an election tension, you will see that US dollar will actually lose value. And the practical example is how it will definitely happen on the chart. So when there is an election in the US, you will discover that it's either USD pair will start ranging, or it will start selling. It will weaken. It will actually weak. So now let's talk about another thing: global trade, export and import. Yeah, this one is very practical. This is another example. If a country export a lot, other countries must buy their currency to pay for the goods, so their currency strengthens. Now, if a country mostly imports, it spend more of its own currency and currency weaken. Example here. Now let me just give one local example. For example, in Nigeria, we import most of the things we use in Nigeria. That is what weakens our currency. We hardly produce most of the things that we use. We mostly import things from number one, China, and number two, the USA. So doing this weakens our currency. But when we export something, another people actually demand for our own currency in order for them to be able to buy our stuffs. So it strengthens our currency. Now let's look at the example. Japan exports millions of cars yearly. Wow, this is a very good example. So people around the world buy JPY. JPY is the currency pair, the name of the currency used in Japan. So that is why you see most of the time JPY pairs are very, very strong, like the USD. Yeah, strong, like strong yen historically. If you look at example of a JPY pairs, most of its movement is actually bullish. Like JPY is always bullish. Now let's talk about another example. Big institutions. We are talking about banks, hedge funds, smart money. Now these people like JP Morgans and other hedge funds, this is part this is the part retail traders feel the most. Big banks moves billions of dollars. When they buy or sell, price shifts immediately. Excuse me. Example, you are trading GBP USD, you are trading the Great British Pound against the US dollar. So your analysis is correct, then suddenly market spikes 40 pips against you for no reason. That is usually institutional liquidity hunting. We are going to talk about liquidity in my upcoming videos, so don't worry. But in a simple definition, liquidity simply means money. So they push price to grab orders, then it reverse in the right direction after market have taken you out. So another thing that moves market is news events. Now, high impact news moves currencies instantly. Now, when you want to see high impact news, you go to one of the popular sites. What is it even called, Steph? Sorry, I'm going to type it on the screen. Hopefully, I can't recall the name of the website right now. But news like NFP, CPI, FOMC, interest rate decisions, unemployment rate, consumer confidence, GDP announcements. So now let's talk about example. All these news events that used to happen on some certain days used to move market actually. People, banks used to react to this news. Now, example, Now, okay, the popular site is Forex Factory, forexfactory.com. That is where you can actually see all this news. And high impact news used to be marked as red, and low impact news I think is yellow. So the low impact news doesn't move market, but the red folder news used to move market actually. Now during NFP, a very popular news event that used to happen especially on Fridays, USD pairs can move 100 pips in 2 seconds. It is like the entire world holding their breath. Then boom, that is it. Now let's talk about another one, market sentiment. Sometimes currency movement is not about facts but feelings. If traders fear recession, they run to save currencies. And what are the safe currencies? I want you to know this because it's very important. The USD and the JPY. But if traders feel optimistic, they move to risk currencies, AUD and SND. Now, example, this is an example, and I strongly believe it's a good one. During COVID, people rush to hold dollars. The same fear-driven behavior moves the forex market on a global scale. So during COVID-19, we all know what happened during that time. If you go back to the charts and within the period of COVID-19, you will see that the USD pair is bullish throughout that time. People actually made money during that time. Market is bullish because of fear. So people run to the safe currency. Now, in summary, currencies move because of interest rates, inflation, economic strength, political stability, trade balance, big banks. We used to call them manipulation, news events, trader psychology. So these are the things that actually move the market, that actually move currencies. So Forex is not really random. It is money reacting to real life events. So guys, if you made it to the end, thank you for sticking around. Thank you for staying around. Thank you for watching my video. And if you derive any value, even if it's a single value, don't forget to return the value by liking this video, comment and share this video with your friends. And if you've not subscribed yet, don't forget to do so and turn on your notifications so that whenever we upload new videos, you will be the first person to know. Thank you and remain blessed.